All right, futures are lower. I'm concerned that the Fed just isn't going to cut as much as we want. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Powell tells Wall Street to cool it, saying he sees no reason to hurry rate cuts. In the next hour, we're going to get the view from Boston Fed President Susan Collins.
Trump deals a blow to EVs. Shares slump on a report that he plans to repeal an electric vehicle subsidy. We'll get reaction from the CEO of Lucid, Peter Rawlinson.
And Trump's cabinet filling up quickly, but there's one notable absentee, Jamie Dimon. The JP Morgan CEO says he didn't want a new boss anyway. Let's take a look at where markets are trading 30 minutes until the bells ring. We have a down day on Wall Street in the pre-market. Of course, retail sales coming in a little bit hotter than expected here. You can see the reaction in stocks right now. The S&P 500 down about 0.6%. Big tech really taking it on the chin. Your NASDAQ 100 down about 1%. Pre-market. The bond market, not sure how to feel. Of course, the bond market since the end of September has been seeing yields shoot higher. Now, of course, seems like the rest of the market is catching on to that message, but 10-year yields still camped out at about 4.45%. Matt Miller, I say this every morning. Very high.
They're pretty high, and maybe that's why people are just still pouring money into money markets. This is a look at the pricing for Fed rate cuts, and we're now below 60% that the Fed even cuts at the next meeting. So as rates rise, the bond market is sending a signal, and investors are starting to clue in, especially since Jerome Powell kind of told us directly yesterday.
I mean, I wonder if by next year we're going to be starting to talk about Fed rate hikes once again. But we will see. Some stocks to watch. We're watching Ulta Beauty down about 5.7% this morning. Warren Buffett's Berkshire Hathaway sold most of its shares in Ulta and bought Domino's and Pool stock. Also looking at electric vehicle stocks after reports that Trump's transition team has been discussing ending the $7,500 subsidy as part of the broader tax reform effort. We're going to discuss that with the CEO of Lucid next hour. Tesla, though, still up almost 0.3%. Rivian now down only 1.2% nearly. Lucid down about 0.5%, Matt.
Yeah, a little bit of a comeback in terms of futures. Of course, we got this news yesterday on electric vehicles during the session, and as a result, you saw Tesla trade down 6%. Still, Elon Musk has other ways to make money.
Oh, yeah.
As we're learning from the FT today.
That man has a myriad of ways to make money, especially when it comes to some of his private companies, SpaceX and xAI. This is according to the Financial Times that SpaceX, which of course is the largest private company in the U.S., it's preparing to launch a tender offer that will sell existing shares at about $135. That would value that company at $250 billion. That's up from $210 billion, which was already a lot. It's just staggering how big this private company is.
Yeah, and it's interesting. These tender offers, they happen a couple times a year, and it is a real model for a lot of Wall Street here on how liquid potentially a private company can get.
For example, Stripe has employed this as well.
Exactly.
I could watch this chopstick landing over and over again. So amazing. But I mean, is it really that profitable? Is there so much scalability here if we're not spending all our money going to Mars?
Think about it. I mean, SpaceX, it's probably going to benefit from the fact that Trump is so close, or rather Elon Musk is so close to Trump right now. They want to launch. Right now,
being the key part of that.
I know, as we've been talking about, how long will this friendship last? But SpaceX wants to launch 6,000 low Earth orbit satellites. Of course, that's for the Starlink network. And he's argued in the past, of course, that it's regulations, U.S. regulators, that have stymied his ambitions.
Hey, you know, at SpaceX, just really quickly, also xAI, FT reporting they've raised $5 billion at a $45 billion valuation. SpaceX and xAI put together is now quickly approaching a third of the value of...
I was going to say, it's only a third. I mean, we talked about how big $250 billion is, plus $45 billion for xAI, and Tesla is worth $1 trillion.
I don't get out of bed for less than $200 billion.
All right, let's talk a little bit about what's going on in these markets with Ann Berry, founder of Threadneedle Ventures. And maybe before, I was going to kick off my questions to you on Powell and the Fed, but what's your take on SpaceX? Yesterday we were talking about this ETF that everybody wants to get into.
It's a closed-end fund. It's specifically not an ETF.
Okay, well, what is it called again?
It's
Destiny's Child.
Destiny Tech 100, DXYZ.
That people want to get into because they think it may have access to private shares in SpaceX. Like, everybody wants a piece of this, right?
I think everyone wants a piece of Elon Musk, and let's talk a little bit about Tesla. I think what Tesla's share price does at this point has almost got nothing to do with EVs because it's Elon Musk's only public company right now. If you want a little piece of Elon, you got to buy a Tesla share. So I think if this vehicle, whether it's the Destiny's Child vehicle, Matt, or whether it's an ETF, gets some SpaceX exposure, I think the demand for that will be to get a little piece of the Midas touch from afar.
What do you think about this XAI valuation? You think about what we see in the public markets on AI-led companies and valuations. Are you going to find a better value in the private markets? And is, some of that frothiness not touchable when you come to the public markets?
I think if XAI were not an Elon Musk company, I would have a different answer for you. I would hone in on your word frothiness, right? I would hone in on taking a look at what's going on with ChatGPT, with OpenAI, what's going on with Anthropic. But because it is Elon Musk, because he keeps pulling rabbits out of the hat in his private companies, I think people say, look, I'm taking a bet on him as much as
And he's suing now OpenAI as well as Microsoft and the Attorney General of California.
A long-running feud, of course, clash of personalities there. But it's interesting. You make the point that everything Elon Musk right now is turning to gold. And really, you've seen that big rally across all asset classes, particularly in the stock market, maybe not the bond market, rally hard since the election. But we've seen a little bit of a retracement. There's a great story on the terminal that U.S. stocks have already reversed a third of that post-election rally. Do you think that sounds right? Is there more of that retracement to go?
I think there's some more retracement to go for a couple of reasons. Number one, I think the stock market was expensive even before this Trump rally, and I think people are taking stock and saying, oh my goodness, equity risk premiums are just at multi-decade lows. Is this really making sense? Number one. Number two, the expectation around interest rates changing. You talked about that. When we are looking at least near term, I think, inflationary fiscal policy. And then number three, Katie, we saw this in 2016. We saw this again here. The Trump rally was meant to be healthcare. Well, guess what? The vaccine producers are down very significantly on the announcement around RFK.
Obesity drug makers as well.
As well.
Stunning.
Right. And the Trump trade has also tended to be defense. Well, now you've got Doge, right? And now you've basically got the overhang of real focus on government contractors, and margins for these kinds of businesses tend to be really rich. So I think what was meant to be a cookie-cutter Trump trade and a rally that came with it, people are now saying, oh, wait a second. The execution of some of those policies may actually go in the other direction.
Yeah, the margins tend to be rich because these government contractors tend to get insanely dumb spending, right? I mean, I always remember reports when I was a kid that the Army was spending hundreds of dollars on toilet seats, yet you still like General Dynamics in terms of a stock. Why, in the face of Elon Musk and Vivek Ramaswamy, do you like these government contractors?
From a super macro perspective, and this is very unfortunate, there is a need globally for a restocking of munitions. There is a need, a lot was depleted, unfortunately, in the war in Ukraine, for example. We know that defense spending is a priority across NATO countries, NATO participants. I think there is going to be real pressure under the new administration to buy American. And I think General Dynamics will benefit from that. And yes, while I think Doge, the overhang of it is there, we will see how long the friendly coalition that is at the top of that lasts, number one. And number two, I actually think when it comes to really hardcore defense, it will be the last thing that entity that Doge will touch, just because the defense implications are so profound.
I'm going to bring us back to where Matt wanted to start, which was with the Fed, because you look at some consumer-heavy stocks here. We talked about ones like UPS and FedEx before, for example. If the Fed is not able to cut as much as investors initially planned for them to, then what comes of the consumer stocks, especially if you think that the government is going to spend less on the economy?
Well, I think if the Fed is not able to cut, which implies that there is perhaps inflation overhang there for longer. I think we continue to see this bifurcation of the consumer market. Inflation has tended to be not as bad for those in the higher income demographics, and that's where I think we will see the more classic Sonali bifurcation of things like luxury doing better than average, and we will see value start to become even more important than it has been with folks like Walmart and the low-cost players playing.
Can I just, even though I love to talk about Doge and Elon Musk has achieved so many things that everyone has thought to be impossible, our base case is not that the government spends less, right? We're not operating on that base case.
You're not taking him at his word?
I mean, it'll be amazing if he does it, but it's so unlikely that the government cuts, the U.S. government cuts spending.
At the very least, they're not forgiving student loans, right? Like, I mean, there's an expectation that there's certain types of spending that will go away.
I have a strong feeling that we will continue to debate this for the next foreseeable few months.
4 years.
And we have to leave it there. It's really great to see
Thanks
you.
for having me.
Have a great weekend when you get there. That is Ann Barry of Threadneedle Ventures. Meanwhile, let's get a look at some of the stocks moving ahead of the opening bell on this Friday. Here's Abigail Doolittle.
Let's start off with a look at those vaccine makers that you all were just talking about on the news yesterday, that President-elect Trump has nominated or is making RFK Jr. the head of the Health and Human Services Department. He, of course, is a well-known vaccine skeptic, obesity drug skeptic, and you can see the related companies down this morning. Turning to Palantir, though, these shares are higher. There's been quite a rally for this stock up on the year into today, up 245%, continuing today amid the news that their listing is moving from NASDAQ to NYSE. And then finally, if we take a look at the shares of Applied Material, pretty decent drop at this point, down 9.1%. This, of course, is a company that makes the machinery that makes the chip, so it's an early tell on chip demand. Apparently, the quarter that they reported, it's good, but apparently the guide for this current quarter, not quite what folks expected. So this concern that we're hearing from some of the companies, and in particular, the semi-cap equipment company Sonali, suggesting that maybe there's some weakness for demand out there for chips.
Abby, thank you so much for taking a look under the hood for us. Now, coming up next, President-elect Trump says there's no room for Jamie Dimon in his cabinet. We're going to have the reaction from the JP Morgan CEO next. This is Bloomberg.
Let's get now to high interest and look at what's making headlines around the world. Russian President Vladimir Putin and German Chancellor Olaf Scholz are said to be holding a phone call today. The call is the first direct communication between the leaders in almost 2 years. The conversation comes at a critical time for Ukraine as the country braces for the third winter under attack from Russia, which with large parts of the country's energy infrastructure damaged or destroyed. Of course, Germany is really dependent on the energy infrastructure, but Scholz is a lame duck anyway, so who cares? In 13F filings, two of the world's most prominent investors, David Tepper and Michael Burry, have signaled an end to their buy everything view on China. Tepper's firm cut its Alibaba stake by 5%, while Burry raised his China exposure but added new bearish options to hedge. And Donald Trump's cabinet continues to fill up, or at least the nominations continue to pour in. One person who won't be joining, though, is JP Morgan CEO Jamie Dimon. Trump shared on social media that he respects Dimon, but he won't be inviting him to join the administration. And Dimon reacted quickly to the news. He spoke to Bloomberg from the APEC summit in Peru.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. I'm not about ready to start.
And joining us at the desk, Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance. We have a lot of names coming out of Wall Street that we know now. Jay Clayton, for example, being the next U.S. attorney for Manhattan as nominated by Donald Trump. What we don't know yet, shockingly, on Friday, is who's going to be the next Treasury Secretary.
And this is really surprising because Donald Trump ran a campaign on the economy. And what he was saying, fixing the economy, tapping into this consternation and concern from the electorate that prices are just too high, trying to remind people that inflation at one point under the Biden administration hit 9%. And yet we don't have the economic team in place. You have CEOs telling us that it's game on. Talking to you, Sonali, Jane Fraser, when it comes to M&A, but we don't know the FTC, we don't know Commerce, we don't know the SEC, and of course the big one, of course, is Treasury and also his National Economic Director. But maybe we will get Treasury soon. Washington Post is reporting that Scott Bessent is in Mar-a-Lago going in for this meeting today with President-elect Donald Trump. Once we get Treasury Secretary, then potentially see the other names get filled out.
And let's talk about that timeline a little bit more. You referenced the Washington Post report. It feels like it's two names that we're talking about, right? Is that fair to say? Is there any possibility of a dark horse for Treasury?
I mean, with the president-elect Donald Trump and the way he operates, of course, there's this potential for a different name to be thrown into the ring. Look at what we saw this week when it came to his attorney general pick with Congressman Matt Gaetz.
Right.
But we should note as well, Scott Bessent is penning an opinion piece today in Fox News saying, let's talk tariffs. It's time to revitalize Alexander Hamilton's favorite tool. There was some pushback on some individuals, even though he seems to have the backing of people on both sides, Jason Furman and someone like Steve Bannon, but there seems to be some pushback within some individuals in the ministry, within the campaign, that he hasn't embraced tariffs as enough. And I think he's putting that to bed this morning with this Fox News opinion piece. The other one, of course, is Howard Lutnick. But Howard Lutnick is the co-chair of the transition, and the Wall Street Journal said then he threw his name into the ring. So kind of the producer now at the last minute throwing his name into the ring to be the star. We'll see what the president-elect decides on.
Sometimes I think Trump is just trolling, nominating the fox to run the hen house. On the other hand, I then remember that, people were going to vote for RFK, a substantial amount of people. Matt Gaetz actually won it's impossible to believe in New York, but in Florida, he actually won election to the next Congress.
There's 1.1 million registered Republicans in Florida. So
yeah, it's beyond just Republican, right? This guy has allegations of having sex with a minor and doing major drugs, but still, Floridians voted for him. So is Trump serious about these picks, or is he just playing some 3D chess that we don't understand?
I think it depends who the pick is. Potentially with Representative Matt Gaetz, who now resigned, so he's just Matt Gaetz. Maybe there is 3D chess going on because everyone was focusing on him becoming Attorney General, the nomination, when in fact he resigned likely because tomorrow the ethics panel was going to vote on potentially making that very damaging report about sexual misconduct, illicit drug use public. Now,
they'll still vote today, right, on that?
Well, yes, but the problem is he's no longer a member. So you're no longer under the ethics committee purview if you're no longer a member of the House of Representatives. Now, who's to say that the senators can't subpoena the House Ethics Committee? That content can definitely go to the senators. Someone like RFK, though, there's two sides of the coin here. You listen to what some Republican senators say, and they say, we like what he's saying about health in America, about food in America, additives that are in American Fruit Loops that are not in Canadian Fruit Loops, and the way the Americans are consuming their food and how it's unhealthy. What senators are not going to like is the vaccine skepticism he has brought to the forefront. But you make a great point. He was on the campaign trail, and people were going to vote for him, and he threw his support behind the former president, and the former president's giving him this nod. Don Jr. yesterday said, promises made, promises kept. Sure, he gave him the nod. Right. Now it's up to these individuals to sink or swim in front of the 53 Republican senators.
That's exactly where I wanted to go next, because you see what John Thune had recently said, all options on the table. How much pressure do they feel, given the threat of these nominees getting through without confirmation from the president-elect's threats here?
Well, all options are on the table. But if you listen also, I think, a little bit closer to what the Senate Majority Leader John Thune had to say, also Shelley Moore Capito was on with our colleagues last night, they continuously stress this idea of process. This is an institutionalist that is now really leading the Senate. I don't see anything coming out of him that really says he wants to negate the process and have a recess. Also, to get a recess, you still need Republicans to vote for that recess. So if you're being told to vote for this recess because the president-elect wants to get through his cabinet nominees, but you're not on board with some of those cabinet nominees, you're not going to vote for a recess.
You need more than John Thune.
You need more. Yes, exactly.
All right, that's a good place to leave it. Anne-Marie, great to speak with you. Have a great weekend. That is Anne-Marie Hordern. She is Bloomberg's chief political correspondent and, of course, the co-host of Surveillance. Now, coming up next hour, Boston Fed President Susan Collins speaks with Bloomberg's Mike McKee. That's at 10:30 a.m. Eastern. This is Bloomberg. Welcome back to Open Interest. Let's get a check on this sell-off in the pre-market. You can see the S&P 500 at session lows, at least when it comes to futures, down about 0.7%. Even worse, if you take a look at the NASDAQ 100, your big tech names down about 1.2%. Small caps, keep an eye on the Russell 2000 because this is very interesting. Pretty much unchanged on the day, even though you take a look at what the bond market is pricing in, now a 50% chance that the Fed actually cuts rates in December. Of course, it had been over 60% yesterday, but then you had Powell come out say that he's in no hurry to cut rates. And
it was 80% yesterday morning.
Yeah. And we also had retail sales really driving home that message this morning, a little bit hotter than expected.
We have been talking about this. You have to wonder if we're going to sit here next year and talk about rate increases.
Dude, I've asked every single guest who's come on the show, where do you see rates restricting the economy? I mean, they're not restricting stocks. Spreads are at record tights since we haven't seen since 1998.
Then what were you saying to me? Because we talk about this, of course, before the show as well. There's pockets of the economy where rates are restrictive. Isn't your mortgage rate at 3%?
It's true. So I'm guilty of... I got a 3% mortgage, and then I forget about the people who are paying more. So there are people, consumers in the economy, for whom these rates are painful. And I'm sure that those people want to see them reduced.
I wish you could bet on? I wish you could bet, like, on DraftKings on the idea of a 7% mortgage next month.
I feel like that's
you can do that in futures, I think.
Yeah, you can do that in financial markets.
We can.
There's probably a poly market being created right now as you say that. But I am interested what this means for the small cap rally that we've seen. If rates aren't coming down as quickly as the market had priced, how do we have a sustainable rally in the small caps? It's a big question.
Yeah, and it's one that we'll continue to ask. Coming up, less than 4 minutes to go until the opening bell, and futures are down. We'll talk with Newedge Wealth's, I should say, Cameron Dawson about these markets. This is Bloomberg.
I think there is a...
We are moments away from the start of trading on this Friday morning. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at big drops in futures. S&P futures now down 0.7%. Granted, it's from a relatively high level, right? We crossed over 6,000 on the S&P this week, but ever since then we've fallen, and it doesn't look like there's anything that's going to restrain those drops when Jay Powell is talking about cutting rates at a slower pace. You hear the opening bell there on the New York Stock Exchange. Vertiv ringing the opening bell there. Down at the NASDAQ market site, you have the Hackett Group ringing the opening bell. No idea what they do. In any case, it doesn't really matter because right now I'm watching the indexes. Katie Greifeld standing by to look at the live trade. Are we going to see a big drop today?
It certainly looks like it if you take a look at the price action right now, at least if you take a look at your large cap indexes. On the S&P 500, 6,000 getting farther and farther away, down about 0.6% just in the first couple seconds of trading. It's big tech where most of the pain is concentrated. You can see that the NASDAQ 100 currently off by about 1%. And then someone make this make sense. You have small caps outperforming today. Of course, the big fear that's working through these indexes is that rates are going to come down at a slower pace. Why that would benefit small caps, I'm not quite sure, but the Russell 2000 currently higher by about 0.4%. Let's take a look under the hood because EV stocks moving on reports that the Trump team may end a $7,500 tax credit. That is a major component of President Biden's climate bill. We'll talk about all of that and more with Lucid CEO in the next hour.
Katie, I'm watching Alibaba over here, down about 0.2%. Revenue missed estimates slightly, but core domestic e-commerce and cloud sales were in line with estimates. Alibaba considering a $5 billion bond offering. I know a lot of people watching commerce around the world erasing some of the losses right now, Matt.
Yeah, we are paying attention to Chinese stocks. As I mentioned, Michael Burry paying attention, David Tepper paying attention, Alibaba looking to sell some bonds. Let's talk, though, about the chip sector right now. AMAT, Applied Materials, beat earnings estimates for the most recent quarter, but is down after giving an outlook that raised concerns over chip spending. And there's a lot to talk about in that area, obviously, as Samsung came out with a $7 billion buyback as well. Meanwhile, in broader tech and mediocre pizza, Berkshire Hathaway sold more Apple stock. It continues to do that because the weighting just gets out of control as Apple gets more and more valuable. But it bought Domino's Pizza. Let's get details with Abigail Doolittle. It's almost insulting for a New Yorker to think about eating Domino's Pizza.
Oh, I disagree with you, Matt. I would definitely order Domino's Pizza here in New York or in Westchester. I think that cheesy bread is really good, but the pizza is too. So there that you have it, Domino's Pizza up 3.5% on this disclosure that apparently Warren Buffett and his deputies like Domino's Pizza, at least the company, and think that it has a lot of potential with a 1.3 million share stake. That's 3.6% of the outstanding worth, and then that overall that is worth $550 million. Pool Corp, the pool equipment wholesaler, they have a 1% stake now in that company worth about $152 million. Those shares higher too. Now, what's out though? You were mentioning Apple. It's not just Apple. Ulta, they've now taken out most of their Ulta stake. That stock down 1.6% in reaction. Apple responding down 0.8%. Bank of America right now up just a little bit. It had been down earlier on the news that they've pared that stake a little bit. But the biggest news perhaps out of Warren Buffett and Berkshire Hathaway quarter after quarter is this cash stake. Take a look at this. At this point, a record, almost 50% of their overall holdings. They, of course, are not market timers, but it's hard to see this massive cash position and wonder if they're seeing something where they want to be more defense. Again, though, they are not market timers, and more of the talk is that they're not able to find opportunities they like. But of course, today, Katie, Domino's and Pool Corp. I'm not sure how you feel about Domino's Pizza.
Abigail Doolittle, I love Domino's.
Me too. It's
Seriously?
so good.
Yeah,
it's delicious.
Thank you for saying that. It's okay to like things. Don't think of it as pizza. It's just very oily, greasy bread with a lot of cheese on top.
I don't know.
Super saucy. It's just basically like, bread doused in red sauce.
I grew up in a place that makes probably the best pizza on earth, Bexley, Ohio. There's a little store called Rubino's that makes the best pizza I've ever had. And in Westchester,
You are so
the
snobby.
Beekman Ale House has incredible thin crust. But
all right, well, Matt is looking down at us from his ivory tower. Let's talk about these markets, though, because Newedge Wealth Chief Investment Officer Cameron Dawson is standing by. Cameron, I am obsessed with what's going on in small caps. And it's really interesting to see them outperform today, to see them outperform over the past month, given what's going on in the bond market, all these question marks over what the Fed is going to do. What is the bull case for small caps, and how sustainable is it?
Well, we think the bull case has two necessary conditions. One is continued resilient economic growth, which supports income statements, but as well as falling interest rates. If you think of the key reason why small cap earnings have been under pressure, it's because of interest costs. So we do think that you need to see interest rates move lower in that very benign, soft landing kind of environment where growth is resilient and we get lower interest rates for small caps to be able to deliver. Because if you look at earnings expectations for small caps into 2025, they're expected for the Russell 2000 to inflect to 40% growth next year, which means that you need that good economy, you need that easing pressure on balance sheets to reach that. The question is that really feasible if the Fed stays higher for longer?
Cameron, I'm also wondering if what's happening here is investors finally flocking to the valuation story in stocks. You had them ignore it for so long, and watching some key stocks just keep melting higher. Is the Russell 2000 trade just a matter of buying things that are a little cheaper at this juncture?
Well, the Russell 2000 is actually trading at 27 times forward earnings. Now, that's because there's a big cohort of Russell 2000 names that are unprofitable. So you could look at something like the S&P 600, their small cap index, which is leaning more to profitable companies. And that's where you can see some valuation attractiveness. It's trading at about 17 times earnings, which, of course, is more attractive or lower than what we see in the S&P 500 at about 22.5 times. But again, it all comes down to those earnings estimates being able to be delivered upon. And one of the key messages from 2024 is that you saw huge revisions down to the downside in small caps. You went from expecting 10% growth at the beginning of this year to now down 20%. And so if you are going to see small caps be an attractive valuation play, it does rely upon the fact that you also have to see them deliver on those earnings.
We done with the small caps? Can
Yeah, you can
move on.
Okay, let's get to the big boy
for now.
here. In terms of the S&P 500, a couple days ago, Julian Emanuel from ISI came out with a note and said this bull market is just an infant. I think they did some studies that showed that the average bull market lasts 50 months and rallies over 150%. And right now, we're at 25 months in, so halfway through and about 65% up. We also have, as a tailwind, I guess, in terms of looking back, the fourth quarter, we usually see a rally of, I think, 4%. Bloomberg did the work there. So do we continue to head up from here, Cameron? Are we going to rally into the end of the year as Santa Claus is coming to town and so forth?
So I think that there's two aspects to that. The first one is in the very short term and through the end of the year. And yes, we do think that seasonals are a very positive driver through the end of the year, mostly because we have started out so strong through the course of this year, which just means that people are sitting on big gains and they are very hesitant to want to recognize those gains in the last 2 months of the year, because if they wait till the beginning of next year, they delay their tax payments until April of 2026. So we do think that that supports this notion of a chase and window dressing into the end of 2024. Then we turn to 2025, and we think we could still very much be in a bull market, but effectively have a year that's a bit more sideways and choppy. So instead of this up and to the right, as we've had in 23 and 24, maybe have a market that looks a little bit more like 2015 and 2018, both years within a long bull market trend, but had lower returns, were a bit more sideways and choppy, that would allow us to grow into these lofty valuations, digest some stretch positioning, and at the same time present great buying opportunities if we do see some of that volatility actually materialize.
Cameron, we don't have much time left, but I want to bring you a contrarian call that we got from Bank of America this morning, saying that basically investors should buy China, they should buy Europe ahead of Inauguration Day, because their thinking is that you're going to see governments and central banks in both of those regions unleash massive support in terms of monetary policy, in terms of fiscal policy. We've heard from a lot of investors that they're backing away from some of those countries right now. Does that call make sense to you?
It all depends on the path forward of the dollar, which means that it all depends on the path forward of the U.S. economy and what the Fed does about a more resilient U.S. economy. If the dollar continues to rally, and it's overbought in the very short term, but if the dollar continues to rally, that usually is a weight on non-U.S. performance. We think that it is absolutely critical to see a U.S. dollar bear market to see sustained outperformance in non-U.S. stocks. So until you're at the point where we're ready to make a call for a big dollar bear market, that's why we continue to prefer U.S. stocks. It's also supported by earnings, quite simply. Earnings expectations, revisions have been far more powerful in the U.S. and have been negative in Europe and in emerging markets, which just suggests that there's a darn good reason as to why the U.S. has been so dominant.
Cameron, we thank you so very much for your time today. That is Newedge Wealth's Cameron Dawson. Now, coming up, Jamie Dimon prepares for an M&A resurgence with the new Trump administration. We're going to bring you his remarks about regulation next. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Bank of America raising its price target on Disney to $140 from $120, also keeping its buy rating. The company's 2025 outlook coming in above the analyst's initial forecast. Next up, Morgan Stanley is downgrading SolarEdge to an underweight with a $9 price target. The analyst says that there is an added level of uncertainty for renewables under a Trump administration. And finally, we have RBC raising their price target on Tesla to $313 from $249. The analyst says that he's more confident that the company can achieve their self-driving goals. Sonali.
And Jamie Dimon, we're going to go to that sound now. He says that bankers are now cheering Donald Trump's regulatory approach, whether or not they supported him. He spoke with Lisa Abramowitz at the APAC CEO Summit in Peru right as Trump announced that Dimon will not be part of his incoming administration. Take a listen.
Because they have the Senate, the House, and the presidency, they have far more ability to do things like that. I think last time around, President Trump had started by saying for every new regulation, 1 in, 2 out. And I think later he said 1 in, 5 out. I think they could do some of that again. I think it will, the banking industry, whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit, and so and you could have kept the banks equally safe, but had them do more credit. And so to just give an example, the average bank in America, I think the number used to have $100 of deposits and $100 of loans, and now it's $100 of deposits and $65 of loans. And if that's what you want, if for some reason the regulators think they're geniuses and that's the best way to run the banking system, so be it. But I think they did a lot of things that ended in that answer, but they didn't know that was going to be the outcome. So, and I think you could talk to any industry, and they'll give you examples of regulation that could be reduced and make it easier for them to do business while keeping the country safe, while keeping the air clean, while making sure the EPA does its job, et cetera. So I applaud them. They should be looking at those things.
Do you think if there is, particularly in the banking sector, less regulation, that there will be an even steeper competition with banks getting back some of the business from private investment firms?
Probably, yeah. I mean, because if you look at, you're asking about private credit and private investment, which I'm not against, and it has grown very rapidly, and it's got pros and cons. I'm always in favor of competition, but part of the reason that they are dancing in the street, which they said publicly, they used to get mad at me, now they say, no, he's right, is half the capital. No social requirements, no AML, no BSA, no fiduciary, no reporting to the government, no insurance, no liquidity. Yeah, it's a huge disadvantage. So yeah, I think it'll make banks get back some of that business. I think it'll be more important to regional banks than to JP Morgan.
There's also a question whether it's banking mergers and acquisitions or just more broadly, whether there's going to be a more amenable administration to tie-ups. Are you seeing from your conversations in the past 7 days with companies that they are looking to expand their M&A pipeline to start putting that together? Yeah, so yeah, absolutely. I mean, a lot of M&A was stymied by the fact it's not just sometimes you can't get through the courts or something like that, but it takes 2 years. It takes 3 years. So make believe you're a bank, and we've seen this happen, and one of these deals actually took 3 years. It takes 3 years to get it done. So you've done a deal, it's binding, you haven't closed it, but now you've got to run the company. You can't get the synergies, you're going to be losing people. You want to start working a common culture and common technology, you can't do it. So yeah, a lot of companies are looking at, will be looking much more aggressively at acquisitions and deployment of capital, and they should.
All right, so there's a ton to unpack there. Great interview by Lisa Abramowitz at APEC. I was really, I don't think shocked is the right word, but impressed by the number in terms of deposits versus loans. I didn't know that, and I think it's amazing that a bank now for $100 of deposits only lends out $65 of that. There's also the private credit and private equity part of it. When I was listening to the interview, actually was thinking about Sonali's reaction, so I want to get that. But then the M&A piece that we've been talking about for so long, and the Chris Hughes piece from Bloomberg Opinion that says there's not going to be a boom. Contrary to everybody else in the world, including Jamie Dimon.
It is interesting, though. It ties into what we were talking about yesterday with Tapestry and Capri, that yes, there's all this optimism coming. The environment should get better, but there's plenty of deals that are still pending that might die on the vine here. You think about Tapestry and Capri, they weren't confident they could get it done by February 10th. That's like 2 weeks after the inauguration. That's probably enough time to save something like that. And that's not even getting to the question of whether
I feel like
the
they just wanted an excuse. They
wanted
an out
to be saved. Exactly.
Well, there's the Wall Street businesses, and even to your point, there is uncertainty, but there is a comeback underway. They'll take what they can get, I think. And on the Main Street businesses, I think this is also interesting. You had a lot of big family offices buying into bank stocks. And if you think about it, Stan Druckenmiller, Soros' family office, they're buying also regional banks. And you see the regional banking index up pretty meaningfully. It's like a banker's sweet spot here to have 4.5% 10-year, right now, and a steeper yield curve that they haven't had in many, many months. And so to your point, it's not that exciting, 12 basis points. 12
whole basis points on your 2s10s.
It's not much of a slope, but so this is interesting, the KBW Bank Index over 10 days. If you look at, Daniel Curtis put together a chart, which is 1334 in the Bloomberg terminal, so you just have to type G #BTV1334 and then press go, and you'll see the chart. It just shows how people have been pouring in to the KRE Bank ETF after the election. At the biggest inflows that we've seen, at least since this chart goes back to pre-financial crisis. Yeah, really shaking up the flow leaderboard when it comes to the ETF world. We'll continue to talk about that. And coming up, investor demand remains high for SRT deals, synthetic risk transfers in the U.S., but Wall Street bets are heeding a warning. That's next in our Wall Street Beat. This is Bloomberg.
it's time now for the Wall Street Beat. We are looking at the investor demand for SRTs, which are synthetic risk transfers, and why there could be some trouble under the surface. It's the subject of today's Big Take, and we're joined now by Bloomberg credit reporter Carmen Arroyo, who co-wrote the story. She joins us now. Synthetic risk transfers. It's when these banks take a bundle of loans, consumer loans and otherwise, they package it and take a risky part of that debt package, offload it to hedge funds, private credit firms. How does this work, and what is the concern?
Sure. So it's exactly what you said. Basically, banks try to get like a credit insurance on the first loss of those portfolios to kind of like bolster their balance sheets, and they become much more popular just because of the environment we're in now, and also because of the regulatory concerns.
So heading into this year, the expectation was we're going to see U.S. banks basically issue a ton of these bonds. What does reality actually look like?
We've seen banks issue these bonds in the U.S., like especially the larger banks, like JP Morgan. However, we haven't seen the flood of banks that were going to come, partly because like there wasn't really a lot of regulatory clarity. So they were like pushing it back to like the latter part of the year. And we haven't seen that flood yet, but the expectation is it's yet to come next year.
So my question when reading the story was, what does the regulator think about this? I only read the first 4 paragraphs, of course. Are they just betting that the regulator won't have a ruling until the Trump administration, and then no one cares about regulators anymore?
Okay, so with SRTs, the Fed did kind of release some guidance last year, and that's when the banks started going to them for approval. So the regulator does have to approve every trade, and clarity on the Basel endgame would be helpful for the banks to actually keep doing this. However, they're going to do it regardless, because in Europe, the use of these bonds is super common, and now banks trying to change to a capital-light model, they need some way to, some tool to do this.
But what can go wrong? Because at the end of the day, it's not just the Fed that is creating guidelines around this, it's also the IMF actually said that this was a financial stability question. So what could go wrong?
So right now, the concern is that there's so many investors trying to buy these bonds, and there's not that much issuance. So banks have the upper hand, and they can kind of ask and whatever they want in a way. So one thing that has happened, for instance, is they're borrowing in much cheaper terms. Spreads have come in a lot. There's concern, especially from veteran buyers, that the new buyers that maybe don't know the asset class that well are more willing to take on risky names or take on laxer documentation.
But these aren't mom and pop investors. These are sophisticated and wealthy institutions.
Sophisticated investors have gotten into trouble before,
right? Yeah,
though.
but they can deal with trouble. That's the whole point.
But not if you're making a bank riskier because you're taking off risky loans.
The bank is buying the insurance, right?
Right, but it frees them up to make more risky loans, in theory.
So the idea, one of the concerns the IMF pointed in their report is that a lot of these funds do use additional leverage to buy these bonds because the tranches are very thick, so they need leverage to juice returns.
Right, and the worry is that they won't be able to pay out on that insurance should disaster strike. Carmen, great story. Carmen Arroyo, they're talking to us about SRTs, which is not, as I learned today, street and racing technology, but synthetic risk transfers. Coming up in the next hour, Thoma Bravo, managing partner Holden Spaht, joins us to talk about its software buying spree. And then later we talk to the CEO of Lucid about the potential end of the EV tax credit. Thirty minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, Powell tells Wall Street to cool it, saying he sees no reason to hurry rate cuts. Later this hour, we get the view from Boston Fed President Susan Collins.
And Trump deals a blow to EVs, shares slump on a report that he plans to repeal an electric vehicle subsidy. Of course, you could have guessed this was going to happen at any point in the last year. We'll get reaction from Lucid CEO Peter Rawlinson.
And as the ETF universe reaches record flows, we're tracking the action specifically in Bitcoin ETFs, which now may own more coins than Bitcoin's creator himself, Satoshi. Let's get a check on these markets right now because we have a sell-off on our hands. You can see the S&P 500 down about 0.8% to close out a volatile week. And a lot of that selling is coming from your big tech names specifically. You can see that in the NASDAQ 100 now down about 1.4%. Of course, part of the reason why is because you had Powell say he's in no hurry to cut rates, like Sonali told us. You had retail sales come in hot this morning, and that's what you're seeing Also in the long end of the Treasury curve, the 10-year Treasury yield now higher by almost 5 basis points. We are knocking on the door of 4.5%.
Yeah, it's kind of been holding steady at that level, hasn't it? Anyways, Donald Trump's election victory is now increasing optimism for a more active deal-making environment moving forward. We've been talking about it a lot on the show, the return of that M&A comeback. Joining us now, Holden Spaht, the Thoma Bravo managing partner behind a lot of the recent deals for the firm. The firm is known for its big bets on enterprise software. And Holden, the whole thing under the market here is how much M&A versus IPOs you're going to see. And there are firms in your own portfolio that look like they're almost ripe to go public next year. How fast do you see it coming?
Well, first of all, thank you so much for having me. It's great to be here. And as you said, we're an enterprise software focused firm. And really, we're known in the market for operational excellence. We buy market-leading companies in enterprise software. We operate them efficiently, we improve their operations, and then we either take them public or we find a strategic or financial exit for it. What happened in the IPO market, in our market specifically in SaaS and technology in 2022 really, was there was sort of a valuation paradigm shift from public market investors wanting growth at all costs to profitable growth. And so the revenue multiples for a lot of the high growth, low profit names were cut in half or more. And that's something that has not really reversed. The good news for us is we've always been the firm that's really espoused profitable growth. That's how we build our companies. And so we have a lot of companies that we think are very viable IPO exits. I mean, when we partially sold Adenza to NASDAQ, that was a 20% ARR grower with 50+% margins. When we sold Ellie Mae to Intercontinental Exchange, that was also a 20+% grower at 50% margins. So those are both really viable IPO exits. We think there's a lot of IPO opportunity in our portfolio, but for the same reasons that I've been talking about, the way we run these companies, they're also very attractive to strategic buyers, which is where we've seen the preponderance of our exits.
Holden, the NASDAQ Adenza deal was kind of like the gift that kept on giving to Thoma Bravo. It was a more than $10 billion deal. Then you had billions more from selling some of the NASDAQ stake that you had gotten in return as well. $10 billion private equity exit last year. How many of those are around the corner? Do you see these mega deals coming?
I think there are a lot coming. So first on that deal, it was a great deal. We find that if we manage the companies the right way and we improve the operations, we professionalize the companies, at some point in our investment horizon, the right buyer presents itself. In this case, it was NASDAQ. And we've become familiar with NASDAQ because they started their mission of to become the trusted financial fabric of the trusted fabric of the financial system is a technology-driven mission. So they, like many companies in the world, have been on a digital transformation journey. And one way to accelerate that is inorganically through buying software. Not only do you accelerate that transition internally, but you also get all the benefits as a public company of owning software, which is highly contractually recurring revenue, good margins, good return on profits. So as you said, we also did reverse diligence on NASDAQ as part of that because we were such big shareholders and said, hey, this is a market-leading company, great management team, and over time, the markets will realize as they execute that the company is more of a data and financial technology company than a market exchange. And it should be revalued on a multiple basis because of that. And so that's kind of been happening. So it has been a great transaction. We're very happy, shareholders still. But when you take a step back, and we've been selling companies over our lifetime to Roper Industries, Heidelberg Materials, Intercontinental Exchange, to a lot of non-software strategic buyers. And when you take a step back and say, this is a massive market, everybody wants to be more of a data and software company, you say there's a massive set of strategic buyers that can buy our companies.
Yeah, Holden, I'd love to get specific here and try to get some numbers out of you because you talk about this opportunity set. As I understand it, you've sold companies with a total enterprise value of more than $25 billion since the start of last November. What could be that number heading into the next year?
Well, we expect similar numbers going forward.
Okay.
We expect similar numbers. We have a lot of interesting dialogues throughout our portfolio at all times. And as I said, we evaluate IPOs. We're building the kind of companies that I think are attractive to financial buyers, strategic buyers, and the IPO markets.
But if there's an M&A boom, why wouldn't that number be higher?
Well,
if IPOs, we keep talking about how the market is ready to for IPOs to come back again? Why wouldn't,
Yeah.
in a year when there's an M&A boom and IPOs are back, shouldn't that number be significantly
and you
higher?
can dual track
I would
it,
say
too.
a couple of things. Well, a lot of people do dual track. I would say a couple of things. One is we have been pretty unusual in getting that amount of liquidity over
Good
this
point.
time period, right?
Yep.
So not everybody has, I think, sold 25 billion of companies. And so we have a relatively young portfolio right now that we're managing and operating. And so as that portfolio matures, I would expect those numbers to grow.
What's dual tracking?
Dual track means either IPO or M&A, and when you have both options, it drives the valuations up of both because you're kind of competing. You know, what about valuations in the software space right now? When you look at the private market versus the public market, what looks expensive? What looks like a value trade to you?
Yeah, it's really interesting, right? I mentioned this move in 2022 where you basically have two classes of software companies. You have high growth, low profit software companies. I think the median SaaS business today trades at about 5 times NTM revenue and has 75% gross margins, grows mid-teens, but only makes 6% EBITDA margins. So a lot of opportunity for operating improvement. But that trading multiple is way down from where it was in late 21, early 22. So that's one class. And then you have the high quality, high profit, market leading companies, ServiceNow, Workday, Salesforce. You look at that sort of set of companies, Viva, you look at that set of companies, they trade at 30 times 2025 EBITDA. Next one. So those valuations have not been as impacted by this valuation paradigm shift. So we think the high quality names, both privately and publicly, are still traded at really, really healthy multiples.
I'd love to talk about whether you think something has fundamentally changed when it comes to the relationship between private and public markets, because I hear what you're saying that we could see more M&A. It seems like IPOs are going to come back, but we've really seen a drought specifically when it comes to the smaller names. A lot of these companies that come public, they skip the small cap, the mid cap indexes altogether. So maybe IPOs are coming back, but do you think that those smaller companies are going to stay private for much longer?
Look, I think the volume of IPOs is an open question. I mean, there was the SPAC boom, then there was, as I said, this long tail of companies that used to go public that had high growth and low profits. At 5 times forward revenue, and small cap, I mean, how long can they, hold off without raising capital? I mean, that's an open question. I do think, that part of the market will potentially be challenged. But I think, go ahead.
Well, it's more about the market, and you're talking about the software valuations 30 times, right? That seems reasonable to you. What about AI? What impact? I think you asked this question a lot to our guest, Katie. When does software start to see the benefit of artificial intelligence that you're seeing in kind of the hyperscalers right now?
Yeah, well, we're really excited about AI. I mean, I think it's an important technology to embrace, not just for our companies and software, but for the economy in general, to help solve some of our debt and deficit problems. But specifically about our companies, we're investing heavily in AI, both, of course, to improve efficiency and the call center and more throughput in engineering, but more importantly, as part of our product roadmaps. And I'll just take Coupa as an example. It's a company I think you've reported on. Coupa is the largest indirect procurement network in the world, right? So they help really large companies manage their procurement processes, save money buying things, right? So really important software. Over the history of the company now, they've got $6 trillion of transactional data connecting buyers and suppliers. You think about how rich that data set is. They're adding $1 trillion to it every year, by the way. Who transacted with whom and how? That is a perfect case study for AI and generative AI and serving up actionable business intelligence at scale. And so these large customers are going to come on that journey with Coupa because of the data set. And really, for me, software, data is the real moat. It's not the application or the interface or the code, it's the data. And so the more proprietary the data set, the more exciting the AI opportunity is. But we think it's the next wave.
Holden, great having you on the program. I hope we can get you back again. Really fascinating stuff. Holden Spaht there of Thoma. Bravo. Coming up, EVs under pressure after a report Donald Trump is planning on killing the consumer tax credit. We'll speak with Lucid CEO Peter Rawlinson next. This is Bloomberg. Let's get now to high interest. Look at what's making headlines around the world. New York is bringing its congestion pricing back, but with a massive discount. Governor Kathy Hochul is looking to push through a revised tolling plan, charging drivers $9 to drive into Manhattan's major business districts. Hochul plans to implement the new charge on January 5th before President-elect Trump takes office. I believe he's against it. Elon Musk is ramping up his feud with Sam Altman. In a revised lawsuit, Musk accuses OpenAI of trying to monopolize the market for generative AI and sacrificing safety in the process. He says OpenAI is taking all the funding and all the talent. And the Financial Times reports that SpaceX is preparing a tender offer in December that would value the company at more than $250 billion. Is planning to sell existing shares in the business at about $135 a piece. That, again, according to the FT. Now, shares of Lucid, the electric car maker, are lower after a report that President-elect Trump is planning on eliminating a $7,500 consumer tax credit for EV purchases. Joining us now is the Lucid CEO, Peter Rawlinson. Here on set, great to have you here in the building. Thanks so much for joining us. I initially thought, why does Lucid care if the $7,500 tax credit is canceled? Because your vehicles at over 80,000 are starting just there, I think, for the Gravity, aren't really eligible for it anyway.
Yeah, they're ineligible through their price point, but there is a route through leasing where a customer would be technically eligible. But there's also a household income threshold, which rules out many of our customers.
So you're not getting a goose from that. You haven't historically, and you won't in the coming year. You just had third quarter sales out that were better than expected. I think it was $200 million, a smaller loss than expected. And you've been taking orders for your new SUV, the Gravity, for I think just over a week now. You've said you plan on selling 9,000 vehicles, if I'm not mistaken, this year. Manufacturing. So what do you expect for next year? Can you give us a little color after your first week of orders for the Gravity about what you expect in the future?
Well, you're quite right, Matt. We've come off the third successive record quarter of deliveries, a record Q1, a record Q2, record Q3. We're assiduously working on our cost structure, and we're showing great results in that respect. Gravity is about to start production imminently. I'm fresh from the factory this week, back to Arizona imminently, and we're going to start production of what I believe is the best SUV on the planet very, very soon, made with a huge dose of pride from Arizona. And we haven't guided for next year's production numbers yet, but what we're seeing is growth in the deliveries of Air and the product that everyone's waiting for, the Gravity, coming. So I think there's a lot of good news to expect in 25.
So we'll keep an eye out for that. I actually want to go back to what a Trump administration would mean for you in 2025 and beyond, because outside of the tax credits when it comes to leases, et cetera, it's clear that Donald Trump isn't really a fan of the EV industry. I know that he is best friends right now with Elon Musk, but that doesn't change his feelings about the EV industry. What do you think that a Trump administration could mean for Lucid, and are you taking any action to plan for that?
Well, I think he's a fan, like so many, of American innovation. And what better example of American ingenuity and innovation than Lucid Motors, the most advanced tech in the world. And I think America is truly blessed with the technology and the technology advantage it has in the EV space right now. And I think that we need to think of the jobs that are created as a consequence of this, great high-tech jobs in Middle America. And you know, any incentive is truly an investment in the future American economy and jobs creation. So I think we should be cognizant of that. But I also would like to state this, that because Lucid's got the most advanced EV technology on the planet, we're able to go further with less batteries. So if there was a situation where incentives were removed, which incentivize the amount of batteries you put in the car, Lucid, amongst all the EV makers, is really the most immune from that.
What do you make of the relationship between the president-elect and Elon Musk? Do you ever worry that perhaps Tesla could get more favorable treatment?
I am eternally optimistic that Lucid will prevail because we are a tech company and we've really taken the mantle of technology leadership from Tesla right now. And this is not really sufficiently recognized. So I think we're in a very strong position to weather any such storm.
I'd say that, so I haven't driven a Lucid vehicle, and I don't have an emotional connection to the brand, but critics overwhelmingly name it as the best electric vehicle that a consumer can buy in terms of the technology and the driving experience. Nonetheless, you need a lot more cash, right? You've got, I think one estimate is that you need about $6 billion more cash before you can get to a break-even rate. The Saudis have already invested, I think, $8.5 billion, including the October equity raise. How are you going to get that? Where are you going to reach? Back to Saudi Arabia? You raise more equity from current investors? Do you bring in new investors? Because Rivian has done a great job of creating a partnership with Volkswagen that must look pretty appetizing to you.
Yes, well, it's a capital-intensive business, as we're all aware. And we've always stated that we will entrepreneurially raise extra cash at appropriate times during the growth of the company. And the last raise, October's raise, is a great example of that, Matt. We raised nearly $1.75 billion, which really helps secure the future of the company. That gives us a financial runway well into 2026. And it's proven that with raising over $4 billion this financial year, this 2024, we've been able to do that when others have found it very challenging. And throughout that, the Saudis have stood shoulder to shoulder with us. And I think it's salient that they have gone pro rata with their ownership in the recent funding round. They've made a commitment to retain their percentage shareholding. So it's all about scale, and the scale comes in 4 steps. Brand awareness driving more Lucid Air deliveries, and we've seen successive quarter-upon-quarter record deliveries. Gravity accelerating that with a far greater total addressable market. This is the product that all America wants, the best SUV on the planet. Right. That's coming imminently. We're working on mid-size platform. That's our Tesla competitor. That's scheduled for start of production late 26. That's our $48,000 to $50,000 product. That's the big one for us. And many of my engineering team are already working full chat on that right now.
Well, Peter, let's quickly talk about shares. We have less than a minute left with you, unfortunately, but they're hovering near a record low. You talk about this opportunity set that you have in front of you. What don't you think that the market is hearing?
I think this is a long-term play. I don't think they're seeing the true value proposition. This is a technology play. It's been recognized, and it's about scale now and assiduous attention to costs. And that's what my team is focused upon.
Peter, we have to leave it there. We thank you for joining us here on set. Certainly an interesting time for your industry and an interesting time for your company. That is Lucid CEO Peter Rawlinson. Now, still ahead, Friday feuds. Mike Tyson versus Jake Paul. Consumers versus mac and cheese. We're going to take a look at what's making the most buzz on social media today. Stick with us. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Alibaba says that it saw robust sales during the month-long Singles Day shopping season. The CEO says that the results were stronger than merchants expected, but you can see shares are lower right now because they did miss on revenue. Next up, it's Fight Night. A clip of Mike Tyson slapping Jake Paul leading up to tonight's showdown that will be streamed on Netflix is going viral. Tyson, 58 years old, he's going to square off against Paul, who's 27, at 8 p.m. Eastern. That event will be the first time that Netflix is streaming a live boxing match, and I might actually watch it.
Yes.
And finally, we have Kraft Heinz. It's failed to convince a federal judge to dismiss claims that it deceptively advertised mac and cheese products as free from artificial flavors, preservatives, and dyes. A district court rejected the company's argument that the consumers failed to establish the citric acid used in the process was artificial. Very interesting stuff. Let's go check on these broader markets, though. It's an interesting market, as you can see on the board behind me. Interesting in a bad way, because you have the S&P 500 deepening its losses right now down by more than 1%. A lot of that pain is just emanating from big tech. As you can see, the NASDAQ 100 now down about 1.8%. The bond market holding its losses. That sell-off isn't exactly accelerating, but of course it is bringing us closer and closer to 4.5%. 10-year Treasury yields up about 4 to 5 basis points. Now coming up, we're going to get exclusive reaction from Boston Fed President Susan Collins. She joins us next. This is Bloomberg.
Welcome to all of our Bloomberg TV viewers and Bloomberg Radio listeners around the world. I'm Michael McKee, the International Economics and Policy Correspondent for Bloomberg, and we are at the Boston Federal Reserve Bank today. They're holding their 68th annual economics conference, and we're joined by the president of the Boston Fed, Susan Collins. Thank you very much for being with us today.
Delighted to be here. Thanks for being at the Boston Fed.
It's great. We tell everybody it's a beautiful day, but it's 39 degrees, so winter is finally hit here.
Seasons are wonderful.
So speaking of winter, December 18th, you have another Fed meeting. And at this point, there seem to be some questions about whether or not the Fed will be cutting rates again, because this week we got some firm inflation news. Retail sales were okay, but not particularly strong. At this point, are you thinking that we should see a cut, or is it better to pause and wait?
So I think it's important to say there's no preset path. I do see rates as still in the restrictive range, which means that over time some amount of easing will be appropriate. But you know, the economy's in a very good place right now, and inflation's coming back down to target. The labor markets are healthy. We're seeing solid growth. The goal of policy is really to sustain that healthy set of conditions, recognizing, you know, there are risks on both sides. And so I think we're well positioned. I certainly wouldn't take another ease in December off the table. But again, we're not on a preset path. And so we'll have to look carefully at the data and see what makes sense when we get to December 18th.
Well, the data this week showed inflation a little bit stronger than it had been in the CPI and the PPI, and those who do the nerdy calculations for the PCE say we're going to see the same thing. Should you keep your foot on the brake a little more then, because inflation is not back down to your target?
So, you know, I don't focus too much on any one data point. I think it's really important to look holistically. And when I do that, what I see is that, first of all, inflation has come down significantly. I focus on the, a couple of month averages. And if you take food, energy, and in particular shelter out, the rest of inflation has actually been in the range consistent with the 2%, exactly what we'd like to see. What's really still elevated is shelter, and that is taking time to come back down, and a lot of that really reflects shocks from the past. I'm not seeing evidence of new price pressures, and so I think it's important to stay the course, but that analysis of the data is part of why I thought it was really appropriate for us to begin easing in September, and to be in an environment where we are really looking over time, methodically, perhaps patiently, to be normalizing policy, to maintain those healthy conditions that I talked about a moment ago.
Well, let's look at the other side of the mandate, employment. We had a very strong employment report, and then we had a very weak employment report, granted affected by hurricanes and strikes. So what's your judgment of where the labor market is when you look holistically at all of the labor data?
So again, when I look at all of the data, and you're absolutely right, there have been some stronger readings, there have been some readings over time that were a bit weaker, and there are a lot of special factors. So looking at averages over time, looking at the range of information, what I see is a labor market that looks similar to conditions that we've considered full employment. So in terms of job openings and quit rates, and the fact that wage growth has been coming down, and given the high productivity we've seen, is consistent with the move back down to 2% inflation and staying there. And unemployment has stayed in a range that is near 4%, low by historical standards, so yes, higher than a year ago. So all of that to me says healthy labor market conditions, things to watch carefully, and don't focus too much on any one piece of data. We have to look at the whole picture.
All right, healthy labor market. Inflation's coming down, even if it's stalled a little bit, but it's in the twos. And the economy is stronger than people had forecast. So do you agree with Chairman Powell in saying there is nothing telling you you have to cut rates very quickly?
So I think that I agree that I don't see a big urgency. At the same time, I do think that preserving those healthy conditions, right? I mean, that's what our mandate really is from Congress. Price stability and maximum employment sustained over time, not just at some point in time. And so, as I said before, I do see the policy stance as being in a restrictive place, and over time, normalizing that, I think, is going to be important. But we're well positioned to be really careful in assessing the data and making decisions about the pace, about the timing, and so that that's how I think about that.
Let me ask about the elephant in the room, and that is the new president-elect of the United States. His policies have not been fleshed out. Chairman Powell's made it clear you don't know exactly what's going to happen, but do you expect that something in whatever his fiscal plans are will affect the economy, and you will have to take another look, say, at what your economic projections are and what the dot plot projections are for 2025?
As we get information about the economy, certainly that includes about fiscal policy. Of course, it's really important to factor that in. And there are lots of things we look at. Fiscal policy is certainly one of them. But I don't want to speculate on what policies that haven't been enacted or implemented might look like.
Well, do you think that tariffs as an economic concept add to inflation?
They can. And again, we would have to see if there are tariffs that are implemented, more about the specifics and the dynamics for those.
Now, if there's a fiscal impulse in whatever the president-elect chooses to do, is the economy growing too fast for that right now? Would that be a danger, a worry?
So again, I think there are lots of things that determine how the economy evolves and grows over time. Fiscal policy is certainly one of them, and certainly does have an impact on that, and we'd have to factor that in and look through that. I do think, and Chair Powell has also said this, that fiscal policy at the moment is on a path that's not sustainable. But again, when we make our policy decisions to focus on our mandate from Congress, it's really based on the data that we have available and the analyses and the assessments that we can do on that basis.
As far as I know, President-elect Trump has never threatened to fire you, but I wanted to ask, what is, in your mind, the relationship between the Federal Reserve and the executive branch?
So what I would say is that the Fed is structured by Congress as an independent body, and that is important in terms of the ability for us to do our job well. There's a lot of analysis that shows that independent central banks are more effective at keeping inflation low and stable. And we have really seen how important it is to keep inflation low and stable in terms of the impact the higher prices past inflation have had. And so, I think that is a very good structure to enable us to do our jobs well.
So the things that come across social media are basically just noise in the background to you as a policymaker?
I am very focused on doing my job, and there is more than enough to keep me very focused and very busy.
Now, the people you can't see them, I can see them out there, all the traders on their knees going, tell us when you're going to do this sort of thing. Can we basically say, because of the potential changes that are coming and the data that we have seen, that the dot plot for 2025 and the SEP for 2025, those are kind of out the window now, and we should really wait until December or even later to get a good idea of where you think you're going to be and the economy is going to be?
Things, I think, always evolve, and so in about a month or so, we will have a new SEP and information from all of the policymakers about what they think. And so I think it's always true that, you know, in the middle of the SEP information, you don't want to take too much from what might have been written down, penciled in, I would say, a number of weeks earlier. A lot of the data evolves.
What are the people who in these tall buildings around us, all the corporate leaders in your district, telling you about how they see the economy going forward and their plans?
Yeah, and I appreciate you asking about that. I think one of the really important things that I do, that my colleagues do, is talk to people across the economy in lots of different sectors. So being out and about throughout New England. And what I'm hearing is pretty consistent with what I said at the outset, that people are cautiously optimistic. They see an economy that seems resilient. Labor markets have moved into much more normal conditions relative to the kind of unsustainable, more overheated conditions from a year or more ago. And the price pressures really have abated considerably. So that's all very consistent. But of course, you know, the aggregate data masks a range of different specifics across individual firms and sectors and regions. And it's really, I think, helpful to hear all of that and pull the qualitative information together with the statistics.
One last question at your conference. It's on financial technology this year, and the Boston Fed's been in the middle of financial technology. And just coincidentally, coming up at the top of the hour, we have our Bloomberg Technology Show. Perfect. So let me ask you, a lot of tech talk over the last 5, 6, 7 years has been tech talk. How fast are we going to see some sort of impact on the average person from new payment systems? I realize you have FedNow in place, but how fast are people going to say, hey, this is something different? And are we going to see any kind of digital currency adoption, whether it's private or government, in the next few years?
So, you know, the impacts of technology have many, many dimensions, and I think we're already seeing some impacts in terms of the roles that fintech are playing across our economy in different ways. And the conference today and tomorrow is intended to really bring experts together who have knowledge and done analysis from different vantage points to see, as we put together the things we know, what are some of the things we don't know and need to know better? And so what we're really focusing on is a number of different themes, including financial inclusion. What are some of the implications of the innovations for access to financial services? And then also, what are some of the implications of technological innovation for the transmission of monetary policy, for our supervision and regulation of financial institutions, and also for financial stability. So thinking about both the opportunities and the risks. And I think we are already seeing some of those implications, but it's still unfolding, it's complicated, and it's moving pretty quickly. So that's what we're trying to better understand. And again, we're delighted that you're all here while we're in the midst of a conference on an important topic.
Well, thank you for having us, Susan Collins, the president of the Federal Reserve Bank of Boston. We'll send it back to you now.
All right, our thanks to Boston Fed President Susan Collins and our own Mike McKee. Some interesting headlines coming out of that exclusive interview. Unfortunately for our purposes, Collins saying she doesn't want to speculate on policies not yet enacted. But that being said, you guys, she did say that she does see policy as restrictive. That is a heavy topic of conversation among the three of us. She favors normalizing, and she's not taking a possible rate cut off the table in December. You take a look at the odds right now as priced into the swaps market. It's just about 50-50.
I think also interesting that she said was that labor market looks close to being at full employment, so not a lot of fear there. We saw that in the data this week as well. You also see her saying that the strong shelter inflation reflects past shocks, and I think that's so important given how sticky that shelter inflation has been.
Yeah, exactly. I mean, it's not coming down. The labor market has been close to full employment for many years now, right? And I guess the question is just, if she's not taking a possible rate cut off the table, does that mean she's thought about not cutting rates?
Sounds like. I'm sure that the answer would be, of course, they think about all scenarios, all situations. In any case, you take a look at this market right now, we are in sell-off mode across equities, across bonds, as, of course, the whole market asks themselves that question. Now, coming up later today, Michael McKee, another great interview in the pipeline, Chicago Fed President Austin Goolsbee at 2 p.m. Eastern. This is Bloomberg. All right, it's time for our daily Wall Street Week conversation. And entertainment companies are looking to AI in an effort to cut costs. David Weston spoke with the CEO of Runway about the AI media company's growth in users and how it generates revenue.
I think the last 2 years have been incredible for us, mostly because the breaking point of quality of models have gotten to a point where it's becoming very useful. The company has grown significantly on both research. We're mostly a research company these days, but also on users. We have tens of millions of users from all over the world, ranging from production studios, from some of the best filmmakers in the world, all the way up to consumers and creators from making small videos. So it's been quite of a journey over the last 2 years.
What's your revenue model? Do studios and other creators pay you a fee for the services you render?
That's correct. Yeah, we basically charge for a fee. There's a monthly kind of license that you can pay. And then if you want to use the product in scale, you can pay for usage. So we charge you for the compute of running that. And so you can create one video, and that might be enough, but we have people creating tens of thousands of videos. And so for that, you can render all of it, and we charge you per compute or per the usage of that cloud compute. Just to give you a reference, I think I was taking a look at how much video our users have created, and I think it's roughly in the estimate of 18 years of video. So collectively, our users have created around 18 years of video combined, which is a lot.
When does Runway become cash positive?
I think we're still at the point where research becomes very important for us in terms of developing the models and training them. And at least for me, a lot of the growth will continue to come from developing these frontier models and then putting them in the best kind of product packaging and the best services. A lot of it has to do with the type of contracts that we do with studios. We have specific, more enterprise offerings that we help studios train their own models as well, and that kind of builds itself differently from just services or licenses. And so we're still early in exploring the product kind of growth.
Do you deal directly with the studios, or are there some people who are sort of aggregators of generative AI?
No, we deal directly with the studios.
That's interesting. Do you have to do a fair amount of training of the studios?
Yeah, there's a lot of training. I mean, this is a new tool. It's a new camera, right? It's a new storytelling device. And if you've never used a camera, I need to show you how to use a camera. You might know kind of the basics of it. You press a button and you're kind of done. But it's a bit more complex than that. And so a lot of what we do is we go into studios and production teams and we show them here's our AI model. It looks like a camera. There's a few things you can do. We'll teach you how to do it. And so we have a studio inside Runway. We have a company that's a small department of Runway that it's basically a studio. People coming from production backgrounds who have been trained on Runway and now go and teach others on how to use it.
You said that you regard Runway as an entertainment company rather than a tech company.
Yes.
Why is that an important distinction?
Because I think the distinction between AI and non-AI for me is meaningless these days. It's AI is everywhere, whether you like it or not. It's going to be as ubiquitous as the electricity and the internet. So it's hard to differentiate companies these days as being internet companies or not. Everyone is an internet company, whether you like it or not.
And that was the CEO of Runway speaking with David Weston. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Well, investment in cryptocurrencies has surged since Donald Trump's election win. And according to Bloomberg Intelligence, U.S. Bitcoin ETFs now hold over 1 million Bitcoins and will likely surpass the estimated 1.1 million held by Bitcoin creator Satoshi Nakamoto. Joining us now is Bloomberg Intelligence ETF analyst James Seyfert. And James, how much is actually in the Spaht Bitcoin ETFs? Could we get there, that 1.1 million figure, by next week?
Yeah, I mean, theoretically, we could get there today with a big enough flow number. We estimate they have about 1.07 million Bitcoin. And the estimate for how much Bitcoin Satoshi holds or held in his wallets is 1.1 million. So we are very, very close to knocking on that door.
So just to remind those who aren't involved, I'm pretty sure that there will be, at some point, almost 21 million Bitcoin, and that's all there will ever be, right?
Correct, yeah. So right now, the ETFs already own over 5% of the Bitcoin that will ever be there. And that's before you take into account that, obviously, potentially 1.1 million from Satoshi is locked up and never to be touched. There's a lot of people, you can search for news articles about people losing thousands and thousands of Bitcoin on hard drives they threw out or lost keys and things like that. So if you account for what you would know as like Bitcoin that doesn't exist anymore or untouchable or frozen or locked, the percentage is even higher.
You know, it's interesting. That is a stunning amount of Bitcoin to hold in a short amount of time. But the supply-demand dynamics make it really interesting here. What do we know, James, about the type of people who are starting to buy these ETFs? It was just 13F season. Are we actually seeing types of investors that we hadn't really seen before?
I mean, if you're talking about institutions, they are dipping their toes in the water. There's a few examples of pension funds and endowments that have, started buying some of these ETFs. But for the most part, it's still largely retail. There is a big advisor cohort. There's over $3 billion from advisors. I haven't looked through the 13F specifically yet today, but the numbers look pretty strong. There's still a lot of money coming from the hedge fund space that likely has to do with the futures basis trade. Essentially, there's like a positive premium to selling futures in the current month contract or a further month out. And then you would basically buy the ETFs, the spot ETFs, to hedge that. So technically, the buying of those from hedge funds should be neutral on price. But right now, there's a whole slew of different types of investors that are buying these ETFs. And I mean, over the last few days, it's been absolutely bonkers, the amount of money that is poured into this. And obviously, you've seen that in the Bitcoin price. And it's not just coming from the ETFs. But yeah, we hit all-time highs this week.
All right, James, great stuff. Have a great weekend. That is James Seyfert. And of course, tune into ETF IQ every Monday at 12 p.m. Eastern. A lot of good news about cryptocurrencies, not a lot of great news about stocks right now. Looks like we're going to end the week on a pretty ugly note with, of course, investors questioning what this Fed is going to do, whether they're going to move at all. You
need to get Eric Balchunas to grow a mustache like that.
I'll try. I mean, I see him every Monday at 12 p.m. noon.
Coming up next week on Open Interest, Citi's Lucy Baldwin, Morgan Stanley's Andrew Sliman, and NVIDIA analyst CJ Muse. This is Bloomberg.